Drill, baby, drill has been one of Trump's primary campaign slogans while he was running for president, and he continues to double down on that agenda. On top of that, Doug Burgum was just confirmed by the Senate, so all of the dominoes seem to be falling into place. Because Trump continues to push for more energy exploration and production, I'm on a mission to find the best and the safest, not just the energy sector. Specifically, I'm looking at companies that deal with oil exploration and production. What's up, y'all? It's Brian. This is my YouTube portfolio series where I invest in a different stock every week. I've been investing about $100. This is a quick look at my portfolio so far. We've only been going for a few weeks, so it's not anything crazy yet, but I wanted to do a quick recap. So we've invested in Hims, DocuSign, Simply Good Foods, Crocs, Zeta, and then this mystery company here at the bottom, which I'll talk more about at the end of the video. So our best holding by far is Hims. It is up 46%. Whenever a company has gone up in value dramatically, I need to do a quick review. I need to know, is this company gone beyond a value investment and it's now overpriced? And then conversely, if a company suddenly drops a whole lot, I need to look into that company and see, my gosh, is there new information out that would change my opinion of this company since I invested? Maybe I need to get out of it because something has changed, or maybe it's just a better deal than ever and I need to double down. So for Hims, let's do a quick look. Hims is now $37, and my spreadsheet analysis put the average analyst prediction at $43 per share. If you want to see the full analysis of this stock, go to the Hims video, which I'll put a link in the description. But essentially what I'm looking to see is, does the stock price rise above the average analyst prediction? And if it does, then I would take a deeper dive into that company. So for now, it hasn't risen to that level. So I'm going to keep holding Hims without doing like a recap deep dive video into it. So for this week's stock, like I said, I'm targeting the energy sector. I'm going to do a 3-step progression to really narrow it down and find the best value today. So the first step, I'm going to use a stock screener. Second, I'm going to use ChatGPT to narrow down maybe the top 10 selections based on the stock screener. And then finally, for step 3, I'm going to use my discounted future cash flow spreadsheet that's automated. So all I have to do is type in the ticker and then it automatically compiles all the data I need. So that's going to be the process. The first step is using the stock screener. I like to use stockanalysis.com. In this case, I'm using 5 different criteria to narrow down the whole energy sector. So first, I want to filter by market cap. I want companies that are over $1 billion in market cap. In general, companies that are bigger are going to be a little bit safer. I don't want small companies. I want to go for bigger oil and gas companies. I want price to free cash flow ratio to be under 20. The price is going to be the market cap of the company divided by the free cash flow. So the smaller that number is, the more of a value that company appears to be. So I'm filtering by that. Price to earnings ratio, which is another value metric, I want that to be under 20. And of course, I'm filtering by sector. I want energy and industry. I want oil and gas exploration and production. So after I run that search, I've got 18 stocks, which are the best value plays in oil production and explorations. I've got it filtered by market cap. So I'm going to take the 10 biggest of those companies that meet that criteria, and I'm going to put those into ChatGPT. Now, normally this goes really well, but this time I had a little bit of trouble with ChatGPT, but yeah, I wanted to show it. This has been my query that I use. It's consistently worked really well for me, but for whatever reason, I had to really urge ChatGPT to give me what I want. So I asked it to rank the following companies in terms of financial health, take into account liquidity, solvency, profitability, and operating efficiency. I tell it to use stockanalysis.com because if I don't tell it what to use, I have experienced it pulling bad data. Grab the latest quarterly reports, and then I give it those stock tickers for the 10 biggest companies that met my criteria. And this is ChatGPT 4.0, which is important. If you use 0.1, it does not have live internet access. So it looks at the companies and it ranks these companies by market cap and revenue, which is not what I asked it to do. So I said, please continue with the analysis. It does the same thing again. So this time I just asked it, why are you ranking them based on market cap? It says, you're absolutely right to call that out. Market cap alone does not determine financial health. So then it starts talking about the merits of using the ratios and metrics that I asked it to use. And then it gives me a step-by-step process where I can do it myself, but this is not what I want. I want it to do it. So I just asked it, do you have live internet access? And just that question, it kind of realized what it was doing. Yes, I have live internet access. I can fetch the real-time data for you. Let me pull the latest reports. So then it says it's pulling all this information, and then it says, please hold for a moment while I gather and analyze the data. So at this point, I walked away, went and got dinner with my wife, came back, and it still hadn't done it. So I asked, are you done gathering and analyzing the data? Apologies for the delay. So at this point, finally, it gathers all the data, which it shows me right here, which I checked, and it did appear to be accurate. And then it gives me the analysis criteria, and it gives me the rankings. So finally, we have Magnolia, Conoco, EOG, Canadian Natural Resources Limited, and Coterra. These are the ones that I'm going to take to the next step. So back to my spreadsheet. Right now, HIMS is in there. So we're going to start with Magnolia. That ticker was MGY. So on my spreadsheet, I just need to type in MGY. I need to remove all of my previous criteria. So these top 3 cells, these are for my personal projections. I use these to adjust the existing data. So I'm not going to adjust any of the existing data. I'm assuming 0% revenue growth for my projection. The past 5 years of revenue growth has been on average 5.43. The perpetual growth rate, which is how much is this company growing after 10 years into perpetuity? I'm assuming a constant growth rate of 3%, just assuming that it's going to grow based on inflation going forward. And then the 5 years, the next 5 years, this is from year 6 to 10. I'm going to also assume a 3-year growth rate. And then I use the analyst projections for years 1 through 5. Now I have to enter that data in manually along with the discount rate and the minority stake. The discount rate is, what is the discount on the future cash flow that I would be comfortable investing at? I just Google. I literally type in the ticker and I type in discount rate. I go to alpha spread, which gives me the cost of equity. And this is the discount rate that I always use. So in this case, 8.03%. And then minority stake, this is something else that I have to put in manually. I have a hard time getting the spreadsheet to do that automatically. So once again, that's just one Google search away. Minority interest is 0. So I put 0 into there. The shares outstanding, that's automatically entered in. And now I just need to manually enter the revenue projections for the next 5 years, according to the professional analyst. So for that, I like to go to stockanalysis.com once again, go to the forecast, and right down here is the revenue growth projections. So I'm just going to copy and paste this into the spreadsheet really quick. The analyst only had 3 years of revenue projections. So I'm going to manually enter in the next 2 years. So for 2027, for the highest projections, I'll throw 15 in there, and then we'll call this one 3. All these companies are going to end up with a 3% projection. The energy sector, oil specifically, is very cyclical. Their profits are going to mainly depend on what is the price of oil at the time. I think the assumption that they're just going to go up on average with inflation is pretty reasonable. In reality, it's going to be up and down and up and down. But if these companies are not dying and they're just kind of staying level, then on average, their revenues should go up with inflation. The average analyst projections are a bit lower than the high. We'll just throw 5 and 5 into here. And then the low actually has them losing money. So we'll put -10 and -5. 3 years of analyst projections and 2 years of Brian projections. So with those projections added in, the analyst low projection is $30 per share. The average is 58 and the high is 91. My projection right here utilizes the annualized revenue growth that I enter. So I'm going with 0 growth over the next 5 years, 3% for the 5 years after that, and then 3% going forward. And then the past revenue projection, this uses the past revenue growth on average over the last 5 years. If they have that again for the next 5 years, then this is the stock price that would result. Magnolia's current share price is sitting at $23.70. Based on my value analysis, the analyst low projection is still above the current share price. So Magnolia looks pretty good. I'm pretty happy with Magnolia, but I'm not going to stop here. I'm going to continue to look at the other 5 companies. Next up was ConocoPhillips. I already have a screenshot here of the analysis, so I'm just going to show you so we don't have to go through and type everything in again. Based on the cash flow analysis for ConocoPhillips, our analyst low projection is about $68. And if we go to ConocoPhillips' current share price, we are looking at $98 per share. The average analyst projection is 108. If they have no growth over the next 5 years, then my projection would be $122 per share. So ConocoPhillips is undervalued slightly according to this free cash flow analysis, but not as much as Magnolia, and it's not as financially healthy. So ConocoPhillips is definitely under Magnolia. Next up would be EOG. Based on the analyst projections, on average, their fair share price today should be be $165. Their current share price is $125. So once again, this company is undervalued according to the average analyst, but according to the low, it's not as good as Magnolia. So Magnolia is very undervalued compared to these analysts' future cash flow projections. Remember, this is taking into account what the analysts believe the company is going to perform in the future, and they're still undervalued despite solid future revenue growth. Next up, we have CNQ. Based on the analyst projections, the analyst low projection, $48, and the average is $101. Canadian Natural Resources Limited, current share price is $30 per share. So this one's looking really good as well. The low projection is 48. The average is 101. If they have zero growth over the next 5 years, then we're looking at 96. So this company could 3x if they just make it to the average analyst projection future revenue. So if that revenue and future free cash flow is accurate, then their fair share price today should be 101. So not only is this an incredible upside, it makes this company incredibly safe because the downside is very limited. They're already priced so low. If they don't perform that well, they don't really have much room to fall. So far I'm really liking C&Q. And finally, the last company is Coterra. Average analyst projection puts it at 52. The low is at 29, but if we pull up its current share price, it's at $27 per share. This one's also slightly undervalued compared to the low projection. So right now my top three are Coterra, Magnolia, and Canadian Natural Resources. However, Canadian Natural Resources has the highest upside compared to all three of these companies. I got to go with Canadian Natural Resources. That's going to be my $100 stock purchase for this week. So on my YouTube public portfolio, Canadian Natural Resources is my 7th holding. The 6th holding, which we have blurred out here, needed a bigger video. I didn't want to just do it live. It needed a little bit more research and production behind it. So if you're curious to see what this 6th holding is, check out last week's video where I went over the Magnificent 7. I'll see you in the next one. Cheers.